If your entire strategy for 2026 is just holding the S&P 500, you are officially playing the wrong game. Most investors think they're diversified because they own 500 companies, but they're actually walking into a concentration trap. While the headlines are celebrating 7,000 points, I'm going to show you why the big players are quietly exiting the room. In this video, we're breaking down the three massive risks that could crush your safe index portfolio, starting with the 15% tariff wall that is already eating corporate margins. By the end of this deep dive, you're going to know exactly how to de-risk your core holdings, and I'm going to show you why you might want to consider these top ETFs for 2026 as your primary defensive shield. Why does this concentration matter right now? Because we are currently facing two massive macroeconomic gravity wells. First, the administration just signed a 15% global tariff on all countries, while the Supreme Court recently struck down the previous version. The new 15% tax under Section 122 is already being priced in. According to recent Bloomberg reports, institutional investors are now entering the Sell America trade. They are rotating out of US-centric portfolios because they realize that a 15% global tariff is a direct hit to the hardware margins of our biggest tech giants. If you are 40% concentrated in tech, you are 40% exposed to a global trade war. Second, we are hitting the AI capex wall. Companies like Microsoft and Alphabet are investing hundreds of billions of dollars into AI infrastructure. But the market is starting to ask, where is the immediate return? If the Magnificent Seven stumble under the weight of these tariffs or a slowdown in AI spending, the 7,000-point floor could quickly become a ceiling. This is where the transformation happens. You do not need to abandon the S&P, but you do need to diversify into what I call institutional levers. These are funds that provide a margin of safety when the hype cycle begins to cool. But before you move a single dollar, you need to understand the data behind the first anchor of our strategy. The first tool in your defensive kit is ticker symbol VTV, the Vanguard Value ETF. While the standard S&P 500 is trading at a forward price-to-earnings ratio of over 28, VTV sits at a much more reasonable 21. When you pay a 28 multiple, you are paying a premium for growth that has not happened yet. When you buy VTV, you are buying companies that are undervalued relative to their actual realized fundamentals. This fund focuses on very specific factors: book-to-price, future earnings, and sales ratios. This methodology results in a portfolio that looks nothing like the standard index. Instead of being overweight in tech, VTV is led by financial behemoths like JP Morgan Chase and Berkshire Hathaway. It owns the energy giants like ExxonMobil and healthcare leaders like Johnson & Johnson. These are firms with massive free cash flow that do not rely on speculative AI bets to justify their stock price. By adding VTV to your portfolio, you are decreasing your tech exposure from 33% down to less than 10%. You are essentially buying a volatility shield. But even a large cap value fund is still vulnerable if the entire US market enters a period of stagnation. If the giants stop growing, where does the real explosive value go? That's where the next ETF I'm going to discuss could have you covered. This is where we look at the most unloved sector of the last decade, small cap value, ticker symbol VBR. While large caps have outperformed for years, the divergence we are seeing in 2026 is historic. VBR tracks the small cap value index, focusing on companies like Williams-Sonoma, NRG Energy, and Atmos Energy. These stocks have zero overlap with the Magnificent Seven. When the Federal Reserve pumps $90 billion into the system, as they just did this month, that liquidity eventually has to rotate out of the overbought tech sector and into these undervalued small caps. This is the classic mean reversion trade. In an environment where the S&P 500 is hitting psychological barriers at 7,000, these small cap value names often provide the second wind for a portfolio. But even with small caps, you are still trapped inside the US borders. What happens if the 15% global tariff triggers a response that weakens the US dollar itself? If you want to truly diversify away from US-specific risks, like the tariff wall or the AI bubble, you must look at ticker symbol VXUS, the Vanguard Total International Stock ETF. This fund is the buy-it-all option for everything outside the United States. It holds nearly 8,700 stocks across developed and emerging markets with 0% exposure to the US. While the Nasdaq and S&P 500 have been volatile this week, international markets like South Korea, Spain, and Japan have been showing surprising resilience. VXUS owns the global innovators like Taiwan Semiconductor, Samsung, and ASML. It gives you European stability, Asian technological growth, and emerging market potential in a single fund with a rock-bottom expense ratio of 0.05%. As the US dollar edges lower against other currencies in response to the latest Fed news, the value of these international assets actually increases for US investors. By holding the S&P 500 as your core and layering in VXUS, you are transforming from a passive victim of concentration to a globally protected investor. However, let's take a look at the charts. While VXUS has been performing exceptionally well in the past year, it has been significantly more rocky than the S&P 500 or Nasdaq 100. We're actually hitting the top of a trend line on VXUS and haven't really had a major correction in over a year. I wouldn't look to buy a significant amount of this ETF right now, but look for pullbacks for better entries. We've de-risked from tech with VTV, captured the mean reversion with VBR, and protected against a US dollar slide with VXUS. But the shield isn't finished until it actually pays you to hold it. That is the role of our final piece, FDVV, the Fidelity High Dividend ETF. While the standard S&P 500 is yielding a measly 1.1%, leaving you entirely dependent on stock prices going up, FDVV is a fortress of quality income. It doesn't just chase the highest yield, it uses a proprietary quality dividend screen to find companies with high payout persistence and dividend growth potential. We're talking about a yield of 2.8%, more than double the standard index, but sourced from the world's most cash-rich balance sheets. Don't mistake this for a slow fund either. Over the last 5 years, FDVV has gained approximately 75%, a growth rate that is remarkably comparable to the S&P 500, despite providing a much higher dividend yield. While the standard index relies on multiple expansion and a few tech giants to drive returns, FDVV delivers nearly identical performance through a mix of steady capital appreciation and a superior cash flow cushion. It gives you the growth of names like Apple and Microsoft, but with the pricing power of a value fund. You now have the technical roadmap to diversify away from the AI bubble, without giving up on the wealth-building power of the S&P 500. We are not predicting a crash. We are preparing for a rotation. But understanding the ETFs is only half the battle. You also have to understand the systemic risks currently threatening the entire software sector. We have already seen over $1 trillion in market value wiped out as the market begins to price in the SaaS apocalypse. I appreciate you watching. If you like the content, please consider subscribing, and I'll see you in the next one.